In the world of finance, fortunes can be made and lost in the blink of an eye. Yet, few stories are as shocking and perplexing as that of Bill Hwang, founder of Archegos Capital Management, and how he lost $20 billion in just 2 days. Welcome to the Cash Puppy channel. Today, we are going to talk about a story that not only shook the world but also made wallets cry. But before we start, you might be asking, how big is $20 billion? Well, it would take around 40,000 buses to transport $20 billion. You can just imagine how much money it is. With that perspective in mind, let's now delve into the story of how Bill Hwang was able to build his wealth and what led to this unprecedented downfall. Hwang's journey began in the 1990s when he joined Tiger Management, a hedge fund run by the legendary Julian Robertson. Under Robertson's tutelage, Hwang became a skilled investor, honing his prowess in the realm of stocks and equities. In 2001, when Tiger Management closed its doors, Hwang established his own hedge fund, Tiger Asia Management. Tiger Asia Management quickly grew in size and reputation, with Hwang becoming known for his aggressive bets and impressive returns. However, this success was soon marred by controversy. In 2012, Hwang and his firm faced allegations of insider trading and manipulation of bank stocks. Tiger Asia Management ultimately was made to settle the charges, paying over $60 million in fines and disgorgements. Despite this setback, Hwang was undeterred. In 2013, he founded Archegos Capital Management, a family office that would allow him to manage his own wealth and sidestep the regulatory scrutiny that had plagued his previous venture. Hwang's investment strategy hinged on leveraging his capital, borrowing vast sums of money from banks to amplify his bets on individual stocks. This high-risk approach was predicated in the belief that Hwang's keen eye for opportunities and his seemingly unerring ability to predict market movements would keep his investments afloat. However, Hwang's past indiscretions had left their mark on the financial industry, and many prime brokers were wary of doing business with him. To overcome this obstacle, Hwang turned to a lesser-known financial instrument, the total return swap. A total return swap allows an investor to gain exposure to the performance of an asset without actually owning it. By using this tool, Archegos could take on massive positions in stocks without actually owning the underlying shares, thereby avoiding disclosure requirements and maintaining a low profile. Over the years, Archegos amassed a highly concentrated portfolio, with significant stakes in companies. It had about $4 billion in capital and owned significant stakes in companies like Viacom-CBS and Discovery. However, the risks associated with this approach became apparent in March 2021, when the stock prices of said companies began to plummet. As the value of Archegos' holdings began to collapse, the banks that had lent Hwang billions of dollars in margin loans started to demand additional collateral. Hwang, however, was unable to meet these margin calls. This triggered a frenzied scramble among his creditors to sell off the assets underlying Archegos' total return swaps. In just 2 days, this fire sale wiped out an estimated $20 billion of Hwang's wealth. But the fallout from Archegos' implosion was not limited to Hwang and his family office. Several major banks that had provided financing to Archegos suffered significant losses as well. These included the Credit Suisse and Nomura, a Japanese investment bank. The Archegos saga raises several important questions about the functioning of the global financial system and the role of regulators in overseeing market participants. For one, the use of total return swaps enabled Hwang to build up massive, highly leveraged positions with little transparency. This lack of disclosure allowed Archegos to fly under the radar of regulators, who were unable to monitor the potential systemic risks posed by the family office's investments. Moreover, the Archegos debacle highlights the role of banks in facilitating and enabling Hwang's high-risk investment strategy. Eager to secure a share of Archegos' lucrative business, these institutions were willing to extend massive amounts of credit to Hwang, despite his checkered past and the clear risks associated with his concentrated bets. According to Bloomberg, the incident was an entirely preventable disaster. Had Hwang's creditors limited his leverage or insisted on more transparency, Archegos would have been playing with fire instead of dynamite. In the aftermath of the Archegos collapse, calls have been made for increased regulatory oversight of family offices and the use of total return swaps. Some argue that the current regulatory framework, which exempts family offices from many of the disclosure requirements that apply to hedge funds, allowed Hwang's risky bets to go unnoticed until it was too late. In conclusion, The story of Bill Hwang and the collapse of Archegos Capital Management serves as a stark reminder of the dangers of unbridled ambition and hubris in the world of finance. It is a cautionary tale that illustrates the perils of excessive leverage, the need for greater transparency, and the importance of robust regulatory oversight to prevent such crises from occurring in the future. What are your thoughts? Let us know in the comments below. Please don't forget to like and subscribe for more Cash Puppy videos.